Hello, my name is Russell Myers. Welcome to Issues Unite. All right, a lot of people have this view that the more the Federal Reserve um, continues to create new currency, that it dilutes the value of the currency, making it less valuable. Now, I've stated before that the value of the dollar has declined uh, by 97% over the past century. And this is true. Now, you think about it, a century ago, you could buy a loaf of bread for 3 to 5 cents, and today it's at least $1 uh, minimum, uh, leaving artisanal bread and all that garbage out of the equation. So, uh, all right, so there is something to this, but it's not really the way people are viewing it. The fact is, the dollar is still, the value of the dollar is higher than it was a couple of years ago. But that's not because of anything having to do with the strength of the dollar. That is because the value of the dollar is derived from, um, you know, comparison to other currencies, and other currencies like the British pound, the euro, etc. All these other currencies have fallen in value. So the dollar is worth more than most currencies at this time. So the problem is not that the Federal Reserve is diluting the value of the dollar by creating new currency. It's what the Federal Reserve does with the currency that they create, and you know that's and what they have done with the interest rate over the past 15 years now. So I'm going to go to a few things before I even start on charts or anything. Let me give you a couple of definitions. Um, Wrong one. Okay. All right. Junk bonds. These are things that I'll explain in a moment. All right. Junk bonds represent bonds issued by companies that are financially struggling and have a high risk of defaulting or not paying their interest payments or repaying the principal to investors. Junk bonds are also called high yield bonds since the higher yield is needed to help offset any risk of default. Just like if you have a lower credit rating, you may be able to get credit, but you're going to pay more for it. Now, junk bonds are very frequently issued by zombie corporations. Zombies are companies that earn just enough money to continue operating and service their debt. Zombie companies have no excess capital to spur growth and are considered close to insolvency. Why is this important? Because the Federal Reserve balance sheet, if you take a look at this, this goes back to 2008. Here's the balance sheet in 2008. This is assets held by the Federal Reserve. So look at what has happened throughout. This is 2018 right here, and yet it was higher than it was in 2010. And then you come up to 2020, and here we are right now. The Federal Reserve balance sheet assets held by the Federal Reserve right now are at $8.3 trillion. Those are assets that the Federal Reserve owns directly. So what are some of these things that they held directly? Mortgage-backed securities. You remember this from 2008, 2009. Mortgage-backed securities. Look at this back in 2008. That was not nothing. It was zero. Then you come up to 2010, 1.1 trillion. Right this moment, the Federal Reserve has $2.5 trillion in mortgage-backed securities. What is the effect of this? First of all, when they're talking about mortgage-backed securities, they're talking about something you may have heard of. CDOs, collateralized debt obligations. These are packaged lumps. They take thousands of mortgages, including high-risk mortgages, put them all into a package called a collateralized debt obligation. And these are highly risky in that context. But the major effect of this is that it drives up the cost of housing, the cost to buy a house, which is why, notice the 2020 and what happened to housing prices in 2020. Well, there it goes. Straight up. Straight up. That was what the Federal Reserve was doing. Buying up mortgage-backed securities, or CDOs. And what happens when the price of buying housing goes up? Well, then equity owners who buy up all the properties increase rents. There are fewer homes available on the market, so that the price on those goes up. Now, keep in mind that for years, the Federal Reserve kept the interest rate at close to zero. So, why is that a problem? Years ago, if you put money into your bank account, into a savings account, interest-bearing checking, what have you, you would get a return on that money. You put the money in the bank, you're depositing that money. In effect, you are loaning that money to the bank so that they can turn around, loan the money out to businesses or individuals, etc., and they would make money from the returns on that. In addition, savings accounts and so forth, and you could buy U.S. Treasuries yourself and get a decent rate of return. But let me get to that in just a second. All right, so other assets held by the bank. Fourth large-scale asset purchases program. This is from 2020, but the chart is current. Other assets besides the mortgages is sitting at $5.1 trillion. So you've got the total balance sheet at close to $9 trillion. You've got total assets 5.1 trillion held by the Federal Reserve, mortgage-backed securities at 2.5 trillion, which is included in this. What is the remainder of that close to 9 trillion? Those are U.S. Treasuries held directly by the Federal Reserve. Yeah. What is the current interest rate? 5 to 5.25. Now, I'm simplifying a lot of this. I know this is a lot to take in. But 5 to 5.25. Why is it stated in that way? The 5% is the amount that a bank will get paid back if they deposit money into the Federal Reserve, which the Federal Reserve turns around and loans to another bank and charges 5.25%. Understand that? All right, so they take it in at 5%, pay out 5%, but they charge 5.25%. So all of this seems like random stuff I'm just throwing out, but here's where it all comes together. Low interest rates encourage borrowing. Why does it encourage borrowing? Well, first of all, banks put money into the Federal Reserve and to invest and get a return on what they put in, which the Federal Reserve turns around and buys U.S. Treasuries and so forth, and they loan out money to banks that are lacking liquidity, in other words, liquid funds. Of course, when they do that, they just print new money, but we'll get into that some other time. All right, so the thing is, when interest rates are near zero, where banks used to make money and where you got money on your savings account, well, now it's close to 0%. So that encourages, with a 0% interest rate, the banks to remain solvent, to make money. They are, in effect, encouraged to make risky loans. They will give credit cards to people with bad credit scores, a poor history of paying off their debts. They will do the same with companies. And one of the stated purposes of this is to encourage growth for companies to expand their operations. That didn't happen. Instead, these companies turned around, borrowed money at low interest rates, and used the money to turn around and buy back their own stocks. Part of inflation, the largest part of inflation, over 90% of inflation, I have stated before, is caused by capitalists, corporate owners, that they're not making enough money, so they increase prices. This is the myth of supply and demand. If there is a shortage of a given commodity, corn, let's use corn. All right, you go to the store last week, last month, you were able to buy 4 ears of corn for $1. Well, people start buying corn. What does the store do? They increase the price of the corn because everybody's buying corn. It didn't cost them more. The farmer isn't getting paid more. But the store can make more money because everybody is buying corn. Where in reality, what should happen is that they keep selling corn until they're sold out. Keep selling it at 4 for $1 until there is no more. That's what should happen. It hasn't. Their cost to acquire it hasn't gone up, but their profit margins have gone up. Now, the same thing happens when the Federal Reserve buys up all of the U.S. Treasuries. It makes it look, or mortgage-backed securities, it makes it look like there is a greater demand than there really is. So prices go up. It makes it appear like the economy is more stable than it actually is, driving inflation. So now the Federal Reserve turns around and increases the interest rate to slow demand. So companies stop buying back their own stocks. They're definitely not using money to expand operations, and consumers facing higher interest rates on their credit cards or to borrow money, they stop borrowing. And every time you make a transaction with an unsecured credit card, you are borrowing money from the bank. And as interest rates rise, they're going to charge you more. Now, companies, it is costing companies more money to remain in operations, not because of the interest rate going up, not because of the interest rate directly, but because during all the years where the interest rate was near zero, instead of building up cash reserves, liquidity, instead they use that money to buy back their own stock. Now they're left in a quandary. To continue operating, they have to keep a rolling credit line for which they're paying higher interest rates. If they turn around, so either they have to pay the higher interest rates, or they have to start selling off their stock, which would cause the values of the stock to go down. They've also been using this money to borrowing money to pay out dividends. So, with higher rates of operations, they are forced to increase prices and or decrease their costs of production and operation, meaning they have to start laying people off. Otherwise, they're going to have to stop paying dividends to their wealthy stock owners. They're going to have to sell off their stock and decrease the value of the stock, making it appear as though they're insolvent, even though the actual company may be profitable. Anyway, so you wind up paying for all of this. Yeah, if interest rates go up by 5%, it costs the company 5% more to remain in operation. They're going to increase their prices by 10% so that they're making more money off of you. So, by the way, little side note, the Federal Reserve buying up all of these assets is called quantitative easing. Now, for interest rate increases to be effective, what the Federal Reserve is doing has been slightly effective, not much, but for it to be effective, if inflation, real inflation, is sitting at 8%, to actually bring down demand, you would have to increase interest rates to 9% or more, which is what happened in the early 80s. It did spark a recession, but it slowed demand. And we're heading into a recession anyway, everyone is saying it now. J.P. Morgan, Deutsche Bank. You can look up all these articles that say that the United States, UK, and Europe are either in a recession or headed into a recession. It is going to be far worse than 2001. I'm expecting it to be worse than 1929 and the Great Depression. They're always going to try and make it sound better than it's going to be. Yeah, just like for the past 15 years, they've been talking about how well the economy has been doing, especially in 2019, when the economy was not doing well. When they measure the inflation rate, they leave out certain things. They leave out food, energy, including transportation, and housing, the main drivers of inflation. So, what would happen if the Federal Reserve turned around and unwound the entire balance sheet down to zero, where it should be? Well, what would happen is that Treasury bonds would have to pay a higher interest rate, which we are seeing already because they've had to slow how many they're buying. Mortgage-backed securities, mortgages. Well, a lot of people would default on mortgages, and the price of housing would plummet. But who would buy it up? Equity investors. Who would buy up everything, which is what happened in 2010, 11, and ever since then. Equity investors would buy up everything and increase rents. Stocks, bonds that the Federal Reserve is holding would plummet in price. As a result, these companies would increase their prices to make up the shortfall. Not because the company is not profitable, but because their investors want a higher rate of return. So, I know this is a little bit confusing, and trust me, I have simplified a lot of this. If you really want to understand it a lot more, there's a book called The Federal Reserve Engine of Inequality that I highly recommend reading or listening to. It goes into a lot more detail than I have done here. So I'm just trying to simplify some of it and put it out there where people can understand some of it. But as far as the Federal Reserve diluting the value of the currency, that has not happened as yet. But it does stand to be a distinct possibility. If, as is happening, there is the move toward de-dollarization, the less the dollar is used, and the more that other countries, people that hold U.S. debt, demand to be paid back, then this can be a problem. Anyway, they're going to demand to be paid what their investment is actually worth. But they're going to be stuck holding the bag. And by the way, yes, the U.S. has defaulted on debts in the past. This has happened a number of times. We have not gone into full default, but we have defaulted on debts. Anyway, share this video, talk about these subjects. If I didn't make some part of it clear, let me know. I hope I brought it all together for you in some way. I'm mostly giving you the pieces that can fit together. Anyway, again, share this video, talk about these subjects. If you can afford it, please donate whatever you can to help expand this channel and my presidential campaign, and I will catch you in the next one. Thank you for watching. Have a good day.